I'm Grant Walker. Welcome to Heads Up for Tuesday, the 28th of April. John Stewart will have last call for you today from 4. To the dairy industry, a Dutch company specialising in shipping perishable liquids is pushing fresh milk exports to Asia. Speaking at the Global Food Forum in Sydney, Trilobe's managing director Diederik Brasser says this could give the Australian dairy industry a head start over New Zealand. He told the Australian newspaper, which sponsors the forum, Australia has a comparative advantage over New Zealand to supply this fresh milk demand by ship because it's closer to major Asian and Middle East markets, and we know we can keep the milk fresh that long. Trilobe and its sister company Milkways have already developed modular refrigerated tank technology that allows bulk freighters to take fresh orange juice from Brazil and Mexico to Europe without spoilage. Dr. Brasser says the high demand for fresh milk in China and the prices they are prepared to pay will only have a real impact on farmers if you can do it in large quantities and large scale. What's being done with air freight is nice, but won't help every dairy farmer. Small volumes of fresh milk air freighted to China sell for $8 to $10 a litre, Australian that is, with demand outstripping supply. Dr. Brasser predicts that Australia's dairy industry could double its annual milk production from 9 billion litres to more than 20 billion. It could also become much more profitable if it was able to bulk ship fresh milk to Asia and the Middle East rather than export commoditised milk powder. Since 2000, Australia's share of growing world export markets for dairy products has fallen from 16 to 5%, while New Zealand's slice has soared from 19 to nearly a third. To our dollar, the New Zealand dollar advanced against a weaker US dollar as traders push out expectations for a US interest rate hike, with both the US Federal Reserve and New Zealand's Reserve Bank scheduled to decide on interest rates on Thursday. The Kiwi rose to 76.39 US at 8 o'clock this morning from 76.12 at 5 yesterday. The TWI was at 79.24 from 78.75 at 5 on Friday. Markets in New Zealand were closed yesterday, of course, for the Anzac public holiday. So the dollar index, which measures the greenback against a basket of currencies, has declined 2.8% over the past 10 days as softer US economic data pushed out expectations for the first Fed rate hike from June to September. With the Fed expected to keep interest rates near zero and with no scheduled press conference or updated economic forecasts, traders will be looking to the tone of the Fed's statement released 6 a.m. Thursday our time for further guidance. And here rates are also expected to remain on hold at 3.5% when the RBNZ publishes its statement at 9 o'clock on Thursday. ANZ Bank New Zealand senior economist Philip Borkin and senior FX strategist Sam Tuck said the US dollar remained on the back foot following further softness in US data flow. Markets continue to liquidate long US dollar positions in the lead up to the FOMC as markets price a dovish tilt from the FOMC should it occur. The New Zealand dollar squeezed higher on US dollar selling. The Kiwi will likely trade between 75.8 and 76.8 cents US today. The New Zealand dollar edged lower to 97.27 Australian. Reserve Bank of Australia Governor Glenn Stevens is scheduled to speak today at the Australian Financial Review Banking and Wealth Summit in Sydney. The local currency was little changed at 70.13 euro. The euro rose against the greenback after Greek Prime Minister Alexis Tsipras appointed Deputy Foreign Minister as coordinator of the country's bailout negotiating team, sidelining the Greek Finance Minister, who was reportedly unpopular with the creditor countries. The Kiwi rose to 90.97 yen and was little changed at 50.16 British pence. An Ormiston update. Workers started on the first stage of the 19-hectare $500 million Ormiston Town Centre in Flatbush. Developer Todd Properties General Manager Evan Davies says it's expected to include 20,000 square metres of commercial property, although it will be subject to market demand. Auckland Council Property, or ACP, is working with developer Todd Property to master plan, design and develop the 100,000 square metre town centre on council land, which will be part of the new 1,700-hectare Flatbush town planned to house 40,000 people by 2020. Originally, the town was being planned by Nigel McKenna's Melview Group when it ran into financial difficulties and he was bankrupted. Todd took over with a new plan and new name. Small to medium businesses are being offered space of 100 to 200 square metres. Bigger companies pre-leased space of 500 square metres, plus with a range of leasing and buying options and varying specifications. Construction of 63 terraced homes is ready to start, and a new 6,000 square metre pack and save supermarket is well underway in the new town centre, which will be integrated with the 94-hectare Barry Curtis Park and straddle Ormiston Road to the east of Ormiston Bridge. Further down Ormiston Road, Kirkpatrick Group has bought the 16.4-hectare Fairmont Golf Course, which is zoned Light Industrial Business 5 under the proposed unitary plan, although real estate agents say any development apart from residential is difficult to make financially viable these days because of land costs. Auckland Mayor Len Brown says more than 84,000 people live in 22,000 households within a 5-minute drive of the planned town centre, and Ormiston's population is expected to exceed 125,000 people by 2031, making the town centre critical. He said with Auckland's unprecedented growth, projects like Ormiston are an essential part of catering for increasing housing demand and access to services. A new library, cultural, community and aquatic centres planned for town centre are likely to be worth about $30 million. Mr Evans said the town centre is a 21st century version of the kind of old neighbourhood centres that are scattered around Auckland. The first stage will be finished in December and the entire Ormiston town centre will be completed in 2023.
NBR Radio with Baldwin's Intellectual Property, turning ideas into profit.
To the courts. A High Court judge has allowed living expenses to be released to internet entrepreneur Kim.com. The German giant went to the High Court in Auckland in February, asking that the remaining $4.6 million he has in government bonds be unfrozen. Mr. .com said his estimate for continuing legal fees was $2 to $4 million, and he wanted $186,865 a month in living expenses. The Crown, joined by a movie studio opponent, said he should not get the money because he's had access to other unrestrained funds. Mr. .com said he needed the money because his trust mostly comprised shares tied up in Mega, and while this was estimated to be worth about $30 million, he could not access it because the shares are blocked from sale until the listing in late May. Justice Courtney has already held that Mr. .com's legal expenses will not be subject to a reasonableness test. Justice Patricia Courtney said the costs Mr. .com had proposed for shared care for his 5 children, 2 of whom are autistic, was not unreasonable. The decision says it's the costs associated with the house Mr. .com occupies that have been the subject of most criticism. She said while the rent is $1 million a year, or about $80,000 a month, there are practical considerations in requiring a change to more modest accommodation. Justice Courtney said little would be saved by requiring Mr. .com to move into more modest accommodation pending expiry of the lease. I therefore accept that in the particular circumstances of this case, a figure of $80,000 a month is reasonable for accommodation. The judge also found the maintenance cost for the grounds and pool reasonable, and also allowed $15,000 per month for security, $35,000 for staff and $20,000 for general expenses. She reduced a staff allowance from $35,000 to $25,000 and said $20,000 was too high, reducing it to $15,000. In all, Justice Courtney released $170,000 a month, which Mr. .com has until his lease expires, at which point it will be reviewed. Mr. .com told NBR Radio he is grateful for the decision, saying it's fair and reasonable. He said it gives us a fair chance to fight back, something Crown Law tried to prevent. All we need now is a little bit more time for the new and finely funded legal team to prepare for the extradition hearing. I'm hopeful, he said, that the High Court will ensure that we get a fair extradition hearing by giving the new legal team enough time to prepare. The High Court last week heard a judicial review application to review a Judge Nevin Dawson's decision to have the extradition hearing on June the 2nd. That decision has been reserved. In politics, Prime Minister John Key has once more defended his pulling of a ponytail of an Auckland waitress, saying he would need to be a bit more careful in future, but that it wasn't a case of abusing his powerful position. He told Q&A's Corin Dan on Sunday, "I think it's the opposite to what some people might think, that there's a power imbalance. It's actually the opposite. I've been mucking and sort of a little bit and having a bit of fun. I accept that, but actually in doing that, I've badly misread a situation." He added, "And all I'm simply saying is from every experience that you have in life, you can't reverse things that have happened as much as you might 100% want to. But what you can do is learn from them. And I have to mark this down as something I got wrong, and therefore I have to learn from it." Mr. Key conceded that the media coverage of the incident this week looks awful, but that most people would have thought it was a bit of a laugh and that many knew him as a friendly guy that liked to interact with the public. Mr. Key said, "I'm probably the most casual Prime Minister New Zealand's had. There's been," he said, "some real advantages of that. Occasionally there's some disadvantages. I can't say any more than what I've said, which is in the end, it was a very casual environment. I knew the people well. I kidded around with them a lot. That was part of that. When you look at it played back in the media this week, it looks awful. At the time, most people would have said it was a bit of a laugh, but actually, I got that wrong. I have to apologise, and that's what I've done. Unfortunately, I can't change what's happened. I just have to live with that. To our stock market. An analyst says hunt for value in the New Zealand stock market and you'll be searching in a barren place. Morningstar analyst Nachi Moghi told NBR Radio investors chasing yield have driven up share prices, especially in the property, telecommunications and utilities sectors, to the point where the market is looking increasingly overvalued. He says the problem is the stocks have gone up in unison, barring a few, but because yield is still attractive in the New Zealand market, investors have driven up the price of these stocks to the extent the multiples have come down from 5 to 6% a year ago to 3 to 4% now. Price earnings premiums relative to the rest of the world are stretching, but it's hard to say whether this will change soon, so investors should not be too tricky with trying to time the market. He says it's a global market, so whatever happens in the US or elsewhere, like a big sell-off, impacts our markets as well. So does this mean investors should step away? Well, not quite, says Mr. Moghi. At the moment, the New Zealand market is a barren place in the search for value. There are no best ideas at present. Investors can allocate some of the cash they have at their disposal to investing in stocks, but significant amounts of allocation towards equities will not be advisable. However, current market multiples still look attractive compared to a 10-year bond, for instance. The property sector, although more highly valued than in recent years, still offers reasonably attractive yield compared to other markets such as Australia or the US. New Zealand's major property stocks, Precinct Properties, Kiwi Property Group and Goodman Property Trust, are fairly valued according to Morningstar, offering distribution yields of between 4.5 and 5.5%. Compared with the past, these yields are low, but still compare favourably with offshore real estate investment trusts, which typically yield 3 to 4%. This is because the appreciation in New Zealand commercial property coincides with a strong rental growth outlook, while overseas property value appreciation is largely a result of investors accepting lower yields, according to Mr. Moghi. The healthcare sector has become expensive with the fall of the New Zealand dollar against the US dollar, pushing export-oriented Fisher & Paykel Healthcare above Morningstar's fair value estimate. But retirement village operator Ryman Healthcare is still fairly valued and expected to show double-digit earnings growth for the next 3 to 5 years. Mr. Moghi says, however, he finds little value in the electricity sector, with supply outstripping demand and the medium term and electricity prices depressed.
NBR Radio with AUT. AUT Research, benefiting New Zealand. AUT.ac.nz/catalyst.
I'm Grant Walker. Welcome to Heads Up for Tuesday, the 28th of April. John Stewart will have last call for you today from 4. To Christchurch rental prices. A dramatic report about 8% residential rent increases by Trade Me may not give the whole picture. There's no doubting rents are on the rise, although the rate of growth continues to lag the overheated rise in house sale prices. Christchurch leads the way in rental growth, with Auckland close behind. Some of the Christchurch rise is possibly short-lived as people move into temporary rental accommodation for home repairs and rebuild workers move on in a year or two. But anyone wanting a record of actual rents in their area can phone Tenancy Services to obtain latest figures. Trade Me Property produces median rent statistics, as opposed to Ministry of Business, Innovation and Employment data used to calculate market rent for regional housing reports. Neither sets of figures measure rent paid by all tenants. They only capture the weekly rent for new rentals on the market. Tenancy bond data measures the average rent of actual bonds lodged by private landlords with MBIE. This measures the actual price of new rentals. Under the Residential Tenancies Act, every landlord who receives a bond is required to lodge it with MBIE unless specifically excluded. There is no distinction between furnished and unfurnished properties in bond data. Another big difference between the Trade Me and MBIE figures is that Tenancy Services collects more rentals at less than 500 a week, while Trade Me has more listings in the 600 plus a week level. According to information on the Tenancy Services website, a significant volume of rental turnover in the lower price range of 200 to 500 a week is not listed on Trade Me. Rental properties included in the Trade Me asking rents may not actually be let to a tenant. Potential tenants may consider the rent too high, location undesirable, or there is plenty of supply. The difference is accentuated in Christchurch due to the earthquakes and subsequent rebuild program, which has reduced supply and increased demand. For instance, there's been an increase in supply and demand of short-term rentals for those displaced by earthquake repairs or rebuilds. Although these rentals are listed on TradeMe, typically they do not appear on the Tenancy Services bond data, as the landlord does not ask for a bond. According to Tenancy Services in Christchurch, therefore, the Tenancy Services bond data is more accurate in measuring changes in the longer-term rental market. The latest report from Auckland property managers at Crockers quotes the nationwide rent rise level of 4.2% in the year to February, continuing to defy expectations of a more significant acceleration in rental inflation. To Wood, a US $780,000 shipment of logs has left the country, but the Japanese company claiming title to them is not out of the woods yet. Earlier this month, Japan's Itochu Corporation applied for an interim injunction in the High Court at Auckland, stopping a group of Kiwi Forestry International companies, as well as Taitokoro Forests, from holding on to a shipment of logs. Just who held title to the pine is at dispute, after branches linked to KFI fell over last month, owing about $26 million. A ship was due to arrive days after the hearing on April 19, with Itochu desperate to get the logs over the rails at Marsden Point in time for export. But Kiwi Forestry International, KFI, is claiming the goods for TFL, which is a forestry company that hires contractors to fell trees. A minute from Justice Anne Hinton last week says the KFI companies in Northport, where the logs were held, had to take all necessary steps to load the pine for shipment at Itochu's discretion. But Itochu was to deposit and hold in a New Zealand solicitor's trust account the equivalent of the total on-sale proceeds of the logs, pending further order of the court. From those funds, an estimated $150,000 is to be paid for the stevedore and marshalling costs required to secure shipment. But Justice Hinton also says documents relating to KFI from Itochu's employee Goro Higaki, including laptop and cloud access, should be made available pending further discovery orders. Kiwi Forestry International owns Harvest Pro, which, in spite of the log market seeing a steady price upswing since last winter, ceased trading last month after its equipment was repossessed by GE Finance. The company owes almost 150 unsecured creditors $1.8 million, and Mercedes-Benz Financial, Itochu Corporation and GE Finance $24.9 million. Harvest Pro had 14 contractor crews employing more than 200 people across Northland and the Gisborne region. While you were sleeping, stocks on Wall Street edged lower as declines in biotechnology shares weighed on the Nasdaq Composite. The Dow Jones Industrial Average shed 0.1% and the S&P 500 slipped 0.2%. The Nasdaq lost 0.5%. The Nasdaq Biotechnology Index declined at 3.7%, on track for its second straight session of losses. The pullback in the Nasdaq snapped a 5-day winning streak. The S&P and Nasdaq both closed at records last Friday, marking the 6th for the S&P and the 2nd for the Nasdaq this year. Several economic reports are scheduled for release this week, including the first reading on first quarter U.S. economic growth, consumer spending for March, and the Federal Reserve's preferred inflation gauge. The Fed statement on monetary policy due on Wednesday will also attract attention. Earnings will continue to stream in this week, including results from 201 companies in the S&P 500. Earnings are on track to decline 2.8% from a year earlier, according to FactSet. A decline in year-over-year earnings in the first quarter would be the first since the third quarter of 2012, when earnings fell 1%. Analysts have slashed forecasts as they expect the strong US dollar and weak oil prices to weigh on profits and revenues. International markets. European stocks rose after Greece reshuffled its team for bailout negotiations. Time is running out for Greece and its creditors to reach a new bailout deal, with the loans Greece owes to the IMF due in early May. So the stocks Europe 600 closed 1% higher. Germany's DAX shrugged off small early losses, declined 1.9%. France's CAC 40 rose 1.3% and UK's FTSE advanced 0.5%. Asian markets rose, with Australia's S&P ASX 200 taking another stab at an elusive 7-year high with the help of gains in mining stocks. It finished less than 20 points short of 6,000, a level not breached since January 2008. And in China, Shanghai shares jumped on the latest rhetoric from Beijing on reform.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
To the markets, Spark New Zealand, formerly Telecom, has slipped from being the country's largest listed company as investors mull its transformation away from telecommunications and the risk of increased competition. Earlier last week, the Auckland-based company's share price dropped to its lowest level since last August. Spark has fallen from being the NZX's largest listed company by market capitalisation, valued at $6.51 billion in February, to the third largest at $5.17 billion. Fletcher Building has the largest market cap at $5.65 billion, followed by Auckland International Airport at $5.45 billion. Spark is chasing earnings growth and a shift away from its bread and butter landline and telecommunications service to focus on data, mobility and cloud services. Last year, it launched its online streaming service Lightbox to compete against global giant Netflix and the local Sky Network Television's Neon offer. James Smalley, a director at Hamilton Hinden Green, said it's hard to see because of the way the digital landscape is changing so much. It might just be that investors in that stock need to get used to the fact that you're not going to get black and white scenarios anymore. They're almost going to have to trust management on its ability to navigate what's probably going to be challenging waters going forward. In 2014, Spark's share price gained some 32% on the New Zealand Stock Exchange, and in early February its share price climbed to a near 8-year high of $353.35. But since then the share price has declined, with Spark being the fourth worst performer on the benchmark index over the past 3 months, having fallen some 12%. Mr. Smalley said uncertainty is one thing that share markets and share prices do not like. Until that uncertainty is removed, you might see continued selling. Adding to Spark's transformation uncertainty, according to Mr. Smalley, was the legal proceedings New Zealand broadcasters, including Sky TV and Spark's Lightbox, launched earlier last week against internet service providers Bypass Network Services, Call Plus Services, Orcon and Flip Services. The broadcasters say the Global Mode service, which gives customers access to offshore online content, breaches the local content provider's copyright. Meanwhile, the arrival of ASX-listed M2 Group, the voice and data services company in the local market, after it agreed to buy New Zealand's Call Plus, the country's third biggest broadband and telecommunications services company, had investors worrying about increased competition during Spark's business transformation. Mr. Smalley said anything that could potentially mean more competition for what was a nice almost duopoly between Spark and Vodafone could be seen as further competition and erosion of margins. Shares of Spark rose 1.1% to 283. The stock is rated an average of hold based on the consensus of 10 analysts surveyed by Reuters, with a target price of $2.94. To the price of wool, New Zealand lamb wool prices rose to a 6-week high at auction last week on increased demand from China for the apparel fibre. Lamb wool rose 4.8% to $6.60 a kilogram at last week's South Island auction, compared with the week before's North Island auction, its highest level since it touched a 4-year high of $6.65 a kilogram on March the 12th, according to AgriHQ. The average price for 35-micron wool, a benchmark for crossbred wool used for carpets and accounting for the majority of New Zealand's production, was unchanged at $5.35 a kilogram. New Zealand lamb wool prices have been buoyant this year, outpacing demand for other wool types. China is the largest buyer of New Zealand wool, accounting for 52% of the nation's $794 million in wool exports last year, according to Statistics New Zealand data. Georgia Toomey, a commodity analyst at Rabobank, said the lamb's wool market continues to ride high in what is seemingly strong demand from Chinese buyers. The market holding up at these levels is very promising, particularly with the New Zealand dollar at its highest level against the US dollar since January, and a weighted currency indicator against all major world trade currencies at its highest level since September 2014. She went on, these positive demand signals have been reflected also in the Australian market, which has been rallying strongly since the Easter recess. Gains have been made across the board at auction, with strong improvement across merino fleece types, as well as consistent strength in the carding and crossbred markets. There was good clearance at the last auction, with 92% of the 9,265 bales on offer sold at auction last week. Some 5,100 bales will be offered at this week's North Island auction, according to New Zealand Wool Services International. To our dollar, the New Zealand dollar advanced against a weaker US dollar as traders push out expectations for a US interest rate hike, with both the US Federal Reserve and New Zealand's Reserve Bank scheduled to decide on interest rates on Thursday. The Kiwi rose to 76.39 US at 8 o'clock this morning, from 76.12 at 5 yesterday. The TWI was at 79.24 from 78.75 at 5 on Friday. Markets in New Zealand were closed yesterday, of course, for the Anzac public holiday. So the dollar index, which measures the greenback against a basket of currencies, has declined 2.8% over the past 10 days, as softer US economic data pushed out expectations for the first Fed rate hike from June to September. With the Fed expected to keep interest rates near zero and with no scheduled press conference or updated economic forecasts, traders will be looking to the tone of the Fed's statement released 6 a.m. Thursday our time for further guidance. And here, rates are also expected to remain on hold at 3.5% when the RBNZ publishes its statement at 9 o'clock on Thursday. ANZ Bank New Zealand senior economist Philip Borkin and senior FX strategist Sam Tuck said the US dollar remained on the back foot following further softness in US data flow. Markets continue to liquidate long US dollar positions in the lead up to the FOMC as markets price a dovish tilt from the FOMC should it occur. The New Zealand dollar squeezed higher on US dollar selling. The Kiwi will likely trade between 75.8 and 76.8 cents US today. The New Zealand dollar edged lower to 97.27 Australian. Reserve Bank of Australia Governor Glenn Stevens is scheduled to speak today at the Australian Financial Review Banking and Wealth Summit in Sydney. The local currency was little changed at 70.13 euro. The euro rose against the greenback after Greek Prime Minister Alexis Tsipras appointed Deputy Foreign Minister as coordinator of the country's bailout negotiating team, sidelining the Greek Finance Minister, who was reportedly unpopular with the creditor countries. The Kiwi rose to 90.97 yen and was little changed at 50.16 British pence.
NBR Radio with Crombie Lockwood. Fight ignorance. Let Crombie Lockwood review your insurance.
I'm Grant Walker. Welcome to Heads Up for Tuesday, the 28th of April. John Stewart will have last call for you today from 4. To the dairy industry, Fonterra, the world's largest dairy exporter, has changed 2 senior management roles in a bid to push its value-add strategy harder in the wake of shareholder criticism over its weak half-year financial results and lower forecast dairy payout. Jacqueline Chow, who's currently Managing Director Global Brands and Nutrition, is stepping into a newly created role of Chief Operating Officer Velocity from June 1, where she'll work with the management team to boost performance across the cooperative. Prior to joining Fonterra in 2013, Jacqueline was Australia and New Zealand General Manager for Arnott's, one of Asia Pacific's largest food companies. Chief Executive Teo Spearing said Chow will lead the next stage in Fonterra's evolution, working across the entire cooperative to push forward the velocity part of our V3 strategy and deliver the best possible performance. The V3 strategy, unveiled in 2012, involves volume, value and velocity, increasing milk production volumes to ensure Fonterra maintains its share of the growing dairy market, driving more value from its milk through higher value products and doing so at speed. The other appointment is Johan Priem, currently President Greater China, who will take on the additional role of Managing Director Asia, Middle East and Africa from August. That role was previously held by Pascal De Petrini, who resigned a month ago after only 2 years in the job in order to return to France to work for his former employer Danone. Mr. Spearing said Priem was well placed to take on the additional role given he had previously held senior leadership positions in that part of the world for other companies. He said Johan will draw on his extensive knowledge, experience and relationships in the region, which includes a number of Fonterra's key strategic markets. As part of the reshuffle, a senior executive in the global brands and nutrition team, René Dedoncker, will take over Chow's former role in acting capacity from June. In March, Auckland-based Fonterra reported a 16% drop in first-half profit to $183 million, reflecting tough conditions in dairy. Sales were down 14% to $9.7 billion. While it maintained its forecast farmgate return for the season at $4.70 per kilogram of milk solids, it disappointed its over 10,500 farmer shareholders by reducing the forecast dividend range by 5 cents to between 20 and 30 cents a share. That led to reports of a number of its shareholders lining up to supply other independent processors, and for Fonterra Shareholders Council Chairman Ian Brown to say shareholders rightfully want to see the strategy provide a return on their investment, especially given the low milk price environment farmers are currently experiencing. A sound strategy is key to adding value long term. To the wharf debate, Mayor Len Brown has brought the Ports of Auckland Wharf Extensions dispute to a head. He's called a meeting for this afternoon with the Ports Company's governing body Auckland Council Investments, or ACIL, to consider the options available to stop POAL building 2 piled extensions at the end of Blentersloe Wharf. The council asked ACIL 3 weeks ago to encourage Ports of Auckland to stop work on the extensions until a year-long future port study is completed. ACIL has also asked specific questions on POAL's business case for the extensions, and discussions have continued. Mr Brown has lost patience and demanded an answer from POAL by the beginning of this week. The council's senior lawyers and governance advisors will be at today's meeting to give advice on the next steps in the dispute. Firing POAL directors could be an option. It was floated by Deputy Mayor Penny Hulse a few weeks ago when she said the board could face a thermonuclear reaction if it didn't stop the wharf extensions. The Mayor is upset at an interview on Radio New Zealand on Friday morning in which Ports of Auckland Chairman Graham Hawkins said the building of the two extensions at the end of Bledisloe Wharf was going ahead as the port had run out of time. He told Radio New Zealand there had been report after report and the time to make a decision had come. He said bigger ships are coming and we have to berth them. He says the port company will pull the wharf extensions out if the port study says they aren't required, but in the meantime it needs to get on with them. Mr Hawkins says the directors had a duty to do what was best for the company and they had consulted lawyers on what was expected of them as board members. Mr Brown says he's disappointed the dispute continues to be played out in the media and he'll be telling Mr Hawkins. He's urged councillors to keep calm heads and work through a considered process that will reach a robust solution. To the OCR, the Reserve Bank will probably change its language in this week's review of the official cash rate after a senior bank official last week said a hike in interest rates isn't being considered at present. Governor Graham Wheeler is expected to keep the OCR unchanged at 3.5% on Thursday, but may drop the language he used in the monetary policy statement on March 12 that future interest rate adjustments, either up or down, will depend on the emerging flow of economic data. Last week, Assistant Governor John McDermott gave a speech saying the bank isn't considering any increase in rates, and before considering a hike, it would need to be confident that increased capacity utilisation and labour market tightness were likely to stoke a substantial increase in inflation. The Consumers Price Index fell 0.3% in the first quarter for an annual rate of just 0.1%, the smallest annual movement since the year to September 1999, figures last week showed. Much of the weakness reflects falling fuel prices, which the bank can look through, and that will reduce headline inflation substantially in 2015 before dropping out by the start of next year, assuming crude oil doesn't decline further, according to Mr McDermott. Labour market data for the March quarter is released on May 6. Dominic Stevens, chief economist at Westpac Banking Corp, said in his OCR preview, the OCR review will probably be more dovish than the press release that accompanied the March 5 MPS press release. Although the central OCR outlook is still on hold, we suspect that the RBNZ will find some way to introduce more asymmetry into its language than it has used in previous massives. At the very least, any reference to the OCR going up will be purged. Governor Graham Wheeler is in a difficult position in terms of his main monetary policy instrument, the OCR, because while inflation is near zero and the Kiwi dollar higher than he projected on a trade-weighted basis, cutting interest rates could prompt banks to reduce mortgage rates, inflaming an already overheated Auckland housing market. The TWI was recently at 79.07 versus the bank's forecast for the second quarter average of 76.7. Traders are betting on 25 basis points of cuts to the OCR over the next 12 months based on the overnight index swap curve. Mr McDermott said last week evidence of weakening demand and domestic inflationary pressures would prompt us to consider lowering interest rates. There are positives with economic growth underpinned by high net immigration, strong employment and construction activity and robust household spending, he said. The central bank's official projection for the 90-day bank bill rate shows it flatlining through until March 2017. Annual inflation is seen recovering by 2016, according to the latest MPS forecasts, but doesn't get above 1.7% through the bank's forecasting horizon, below the 2% midpoint of its target range. Westpac's Mr Stevens said despite our resolutely bullish views on the housing market and economic growth, we ascribe roughly a 40% chance to OCR cuts occurring this year.
NBR Radio with Snap. Work, play and live connected with Snap.
To trade, John Key has defended his upcoming trip to Saudi Arabia, saying a free trade agreement with the kingdom will allow the two parties to talk about a range of issues, including human rights abuses. He's the first New Zealand Prime Minister to visit Saudi Arabia, but critics say he shouldn't do so because of the country's human rights abuses, including beheadings. Mr Key agreed that Saudi Arabia was doing things New Zealand disagreed with, but that it shouldn't prevent trade between the two countries. He told Q&A's Corin Dan on Sunday, "I utterly reject them and don't believe they should do that. But they're taking it against their own citizens. They're not looking to basically get to the point where they murder New Zealanders in their own country or in parts of the region that they travel to simply because we disagree with their perspective on the world." Mr. Key pointed out there were many countries that New Zealand had disagreements with. He said, "We do trade with them and we do travel and go and see them. The question is, over time, can you make changes? I think if we get a free trade agreement, for instance, with Saudi Arabia, we have got a much stronger relationship from which we can talk about a range of issues." To China, food exporters to China could face more delays as the government orders a further crackdown on food safety standards. However, the latest moves appear to be aimed mainly at local suppliers after further scandals involving the sale of toxic or fake food. The National People's Congress Standing Committee, China's top legislative body, has increased penalties by up to 10 times, and the government has vowed to track down companies that fail to meet the new safety standard, which comes into effect on October 1. China's food safety guidelines have been questioned after high-profile incidents such as rat meat was sold as lamb and rotting meat repackaged and served at fast food chains, including McDonald's and Starbucks. It was revealed last week that up to 60% of bottled water sold in China was unsafe, with officials suspecting a lot of drinking water was sourced from tap supplies. Dozens of people have also been charged for selling oil collected from stormwater drains near restaurants. To poll results, a clear majority of participating NBR subscribers believe Rodney Hyde put forward the strongest arguments when he went toe-to-toe with entrepreneur Lance Wiggs about the credibility of anthropomorphic climate change science on NBR radio. The debate between Messrs Hyde and Wiggs was triggered by a column on the topic by Mr Hyde in April 17 print edition of NBR. In the column, Mr Hyde derided the government's efforts to meet its commitment of reducing greenhouse gas emissions to 5% below 1990 levels by 2020, noting that while New Zealand's net greenhouse gas emissions were 38 million tonnes of CO2 equivalents in 1990, they had risen to 54.2 million tonnes 2 years ago. But the full weight of Mr Hyde's scorn was reserved for anthropomorphic climate change science itself. He claimed that given the temperature record had shown no global warming for nearly 20 years, below the lowest estimate the Intergovernmental Panel on Climate Change made in 1990, there is no problem. Mr Hyde's column prompted Mr Wiggs to respond in the online comments section with the observation, "No sense discussing the facts with deniers." Sadly, next generations will have to clean up this mess if there is time. That in turn provoked Mr Hyde to dedicate his next newspaper column to a close passing of Mr Wiggs' comment, which Mr Hyde used as an example of what he described as the shocking deflation of the boosters for global warming, the result of salient facts working against their claims. The two accepted NBR's radio invitation to debate the issue on air and, if nothing else, prove whether Mr Wiggs' contention there is no sense discussing the facts of anthropomorphic climate change with deniers. The resulting 30-minute exchange between the two traversed some of the major points of disagreement between the two sides of the issue and drew increasingly testy as it progressed. In the aftermath, Mr Wiggs wrote an opinion piece for NBR Online on the topic. Both his and Mr Hyde's piece prompted fiery debate in their respective comment sections over the long Anzac weekend, with both writers robustly engaging with readers. The judgment of those subscribers voting on who made the strongest arguments in the debate: over two-thirds, 69%, thought Mr Hyde prevailed in the climate change clash, while 31% thought Mr Wiggs was most convincing.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.